Hi, and welcome to this episode of OmniTalk. So again, we are discussing markets today because markets are again at all-time high, nearly all-time high. Last 3-4 days, mein, I think 1-1.5% it has corrected a bit, but
Sure.
the whole discussion was that it has reached all-time high. Sensex 75,000, and Nifty was expected to cross 24,000 in some
Right.
time.
Right.
So what and if I talk about, let's say, some valuation numbers also, Nifty is somewhere around 23-24 PE,
Right.
right?
Right.
uh, and since the small cap and mid cap indices are also at like 28, 29, maybe
Right.
30
Right.
PE, right?
Absolutely.
So that is the valuation, but most of the people actually look at the past performance
Correct.
and conclude that whether they are closer to highest territories or not. Like looking
Absolutely.
at the last 1 year numbers, large caps have delivered somewhere around 25 to 30% kind of
Right.
returns.
Right.
Mid cap and small cap have done really, really well, close to 60% kind of returns in
Yes.
last 1 year.
Yes.
So while you would feel a lot happy about your portfolios if you had invested in large mid and small cap specifically, लेकिन एक worry है कि यार PE, typical the PE multiples are at high.
Mhm.
uh, so this is something that people are coming back to us and discussing a lot, that what
Yes.
should they
Yes.
do, should they exit,
Absolutely.
should they reallocate to something else. That is something we want to touch today.
Right. Right. Yeah. So all this kind of confusion happens when you do not have any basis of analyzing, right?
Yeah,
So
sure.
then you start thinking along these lines that it's gone up by so much.
Hmm.
So three numbers here, right?
Hmm.
The 75,000 Sensex.
Right.
Secondly, 25 to 30% returns, or for
Correct.
mid cap, small cap, 60%
60%.
plus returns.
Right.
Right. So these two factors make people worry. And
Worry.
third factor is genuine, which is PE ratio.
Hmm. Correct.
So that is a one good number people are looking at.
Yeah.
But the other two don't make much sense, right?
Yeah.
That just because high returns have
Absolute.
happened
Yes.
doesn't mean it's time to sell,
Correct.
right? Because number of years there was no return.
True.
So markets deliver in the long term, right?
Sure. Sure. Yeah.
But that long term return might come in a specific year.
Hmm.
So
True.
anyway, so that is the case. And when now that people are sitting on huge gains,
Yes.
they feel nervous that
Hmm.
something will burst the bubble.
Correct.
Because they feel their corpus is in bubble,
Is
their
bubble. Right.
investment is in bubble.
Correct.
So they are worried then that, okay, what happens with Middle East, what happens with Ukraine, Russia, what happens with Israel, Iran, all
Right.
that kind of stuff,
Right.
right? But the focus should be on, can you create a portfolio? So okay, even before that, so the
Hmm.
question is it time to
Time to exit.
exit, right? And wait out, and
Right.
people say if there is a correction or
Then
something, then I'll come back.
Correct.
So we have discussed this before also, that what are you waiting for?
Hmm.
So now 75,000, it's gone to 73, right?
73,500.
On Monday,
Yeah.
today it's 73,000.
Hmm.
Sensex is at. So does that mean you should now buy?
No. Correct.
That's hardly 1.5-2% drop, right?
True. True.
So so when you are waiting for correction, you don't know what you are waiting for.
True.
Are you waiting for 3%, 5%, 10%,
Right.
20%? And why would it fall by that
About
much?
that much.
And let's say it's at 10%, then are you now saying that, okay, since it's already fallen 10% so fast, maybe it will go to 15?
Correct.
And let me wait for 15, right?
Right.
And you don't know, then it comes back up.
Correct.
So the correct way of doing, in our opinion, is obviously the valuations. And whether you are able to find a set of companies which are robust, which have good growth opportunity, and whether they are available at intrinsic value. Right?
Correct.
If you can't find, then it's
Yes.
a bubble. Then you get out of the market. If you can find,
True.
then you should be invested.
True.
Okay. Anyway.
Yeah, true. So I totally agree. Like typically that, when the market is falling, kind of a scenario, uh, typically it's like if it falls for few, percentage points, then that, kind of thought process still is alive, that okay, let me wait out and,
Exactly.
I'll come or I'll do top up or something. But as you said, if it actually falls by, something more than 5% or, closer to 10%, then actually the fear, psychology actually kicks in.
Right.
And typically there is a strong enough news, a negative news, which makes the market fall by that much, right?
Absolutely.
So then it becomes actually even more difficult to allocate capital, because then you are saying that, oh, now it's an absolute trouble.
Yes.
And you keep playing around when it's like a 2 to 5% kind of a correction, or which is just a trading activity,
or a dip. So you're trying to play that 2-5% kind of dip.
Correct. So for anyone who is allocating capital for long term, actually it is quite simple. Should be simple in the sense that you have to continuously keep allocating, right? And these are very temporary scenarios that are playing out, right? So in terms of fundamentals, let's go back to the basic and say that in terms of fundamentals, how do you see the economy shaping up, and is there any is there an opportunity, or is there things to worry about when I'm allocating capital?
Right. Yeah. So see, when market is at all-time high and high P ratio, then when is the time to, under what circumstances, fundamental circumstances, you should think about exiting?
Right.
So before I get in, it might sound complicated. So right now is not that time.
Correct.
Typically, you have gone through 3, 4, 5 years of very good economic boom, right? So you are at the peak of the economic cycle. Inflation is high because of the boom, not because of supply chain constraints, which we saw, and that is already subsided, right? So because of the consumer demand coming in so heavy and the capex cycle still not able to cater to the demand,
correct,
the inflation is high. So everyone is extremely optimistic in terms of the economy. Interest rates have been increasing to control the inflation and control the growth by the central banks. So all of this is happening, and still it's growing, and the market is booming on high earnings and high multiples. So earnings are also at cyclical peak, and then on top of it you have a high multiple, and then you say this is a bubble, because now the interest rates are on a hike, right? And so interest rates will come down, then economic boom will be over, and then earnings will drop, and multiples will drop, and so on. So that is the time. Today is not that time. So today, what is the situation? Economy is starting to do well post COVID, right? And the balance sheets are clean. Okay. So there is consumer demand, there is government driven demand, capex driven demand from government side, and all of that is giving boost to the corporate sector, right? To supply to this demand, and their capacities are now getting to full utilization after a long period of time, and they have cleaned up the balance sheet with that demand and higher earnings, etc. They have paid off significantly. So the balance sheets are stronger on the corporate side, and balance sheets are stronger on the banks have also cleaned up their NPA significantly. So the twin balance sheet problem, which was there 10 years back, now it's a twin balance sheet opportunity. And the demand is there, and the capacities are coming closer to full utilization. So corporates will borrow, banks will be lending, and that will kick off a new boom cycle. So we are probably at the inflection of that. Okay. Second factor is the earnings are likely to, revenues are likely to grow, earnings are likely to grow till we reach the economic boom, right? So that will happen when the balance sheets of the banks are fully utilized and the corporate balance sheets are fully utilized, right? At the brink. So that means the economy is at the peak, because after that, if the banks keep lending or corporates keep borrowing, their balance sheets are weakening, and so it's naturally going to collapse after that, right? So that, again, household balance sheets are also clean. So this is the inflection point. Okay. So earnings, revenues are, cash flows are going to increase. Second point comes is the interest rate. We are on the verge of an interest rate cut cycle. Right. So in India, it might not be so much, but the global Fed is at the absolute peak and very high numbers.
Correct.
So over next 18 months or so, it should go down by around 200 basis points, right? Or maybe more, but at least 200 basis points. Correct. While India could be 100, 250 basis points, somewhere in that range. So it doesn't make sense to say that this is a market
Right.
peak
Correct.
or bubble.
Sure. So unlike after a typical economic boom and
Hmm.
markets becoming really overvalued and entering a bubble, this is actually just kind of opposite to that, where
Yes.
you have very good setup for the future economic boom,
Yes.
and interest rates are actually not expected to go up, but
Come down.
come down actually. So it's good for demand. It's good for then eventually better
It's good
growth
for the economy as well as
and
good
the
for the market.
markets. Yeah,
Yes.
perfect.
Yes.
So what should one do, like in this scenario? The thing is, uh, people are still not able to get comfort from the headline multiples are still
Which is true.
or not in a very comfortable zone
Which is
from the
true.
valuation perspective.
Absolutely.
Coming back to the valuation,
And
so,
mid cap and small cap is at nearly 30.
yeah,
Right?
yes,
28
yes,
to 31 or so.
absolutely,
While the large cap is also 23, 24, 25,
correct,
which is not that high,
right,
in my opinion,
right,
the large cap. But mid and small cap, it is high. And if you are in an index fund or
right,
a ETF
right,
or a typical mutual fund,
right,
then this is the multiple you're getting.
you're going to it,
And sometimes in some mutual funds or PMSs, it could be even higher.
correct,
Right? And so flexi cap, multi caps, mid cap, small cap, all these funds are likely to be overvalued.
true.
Uh,
And
only
definitely
think,
the pockets of like really overvalued companies we have seen across, like in the
absolutely.
and in the mid cap and small cap, they are actually the larger companies, so the index is reflecting that valuation. While
Yes.
in large cap, I think uh, there are huge pockets of overvalued companies, but I think some of the larger companies are still favorably priced. That's why it's not reflecting completely in the index level.
Right. Right. So large cap, first of all, itself, the PE itself is
Is-
23, 24,
right.
25. But on top of it, if you look at large cap, there is a very different dynamics,
Right.
which is a lot of banks are there,
Right.
a lot of IT companies are there.
Correct.
We have discussed this before, that the earnings of these companies itself are likely to go up. So the earnings are non-normalized.
Absolutely.
So what looks like 23, 24, 25 might actually be 17, 18, 19.
Correct.
If you normalize it.
Right.
So that itself, large cap is a slightly different thing.
Correct.
But mid and small cap, if you buy a fund,
Hmm.
you or PMS or the typical index fund,
Right.
you are actually buying an overvalued portfolio.
And one can check, by comparing the fund multiple with the index and
Yes,
see, and
yes.
most likely it is going to be in the similar
Yes,
range.
yes.
Yes.
So that wouldn't make sense,
Right.
except for large cap, as I said, it will be okay.
Right.
It might be okay if they are going to allocate to the undervalued
portion.
In which case, again, the multiple of that fund should look low
similar.
even today.
Right.
Okay.
True.
But it doesn't look. Most of the funds, I don't think, looks like that.
Right.
So it looks overvalued, and it would be investing in overvalued if you do that. So the solution is actually to make your own portfolio.
Yes.
Right, of direct equities, which are not overvalued.
True.
Right, and that doesn't mean go and buy low P. We already discussed the flaws of that, or the
how to go about how to understand P ratio itself.
Right.
So I think the enough large universe of stock in, let's say, when you specifically talk about small cap or even mid cap, larger than the universe size is larger than the large cap.
Yes.
So you have enough number of companies.
Absolutely.
But so you said you can create your own portfolio, but
absolutely,
how can someone look at that? What is the framework?
right?
Say?
Right. So we use the scientific investing framework, right? We have discussed that before in other videos as well, but we'll discuss that here as well. So just to give you an example, there are, let's say, 1200 companies above 1000 crores market cap, right? So out of the 1200 companies, we don't like weak balance sheets, right?
Sure.
Or loss making companies, what we call capital destroyers. So you take those out.
Right.
Second step is taking out the capital eroders. These are companies which are earning, don't have persistent competitive advantage, do not have pricing power. So their return on equity is low.
Right.
You take those companies out. Third is capital imploders.
Right.
These are extremely overvalued companies. So everything, let's say, above 50p, 40p, 35p, all that should go out, right?
Right.
Or ideally below 25 is better.
Correct.
Right. Otherwise, if you are willing to buy 30p, you might buy the mid cap and small cap funds.
Funds.
Okay.
Right.
So you are saying 25 or below, or 20 or below, right?
Yes.
Those kind of things. So you look for that.
Hmm.
Okay. And so strong balance sheets, high profitability,
Correct.
competitive advantage, persistent competitive advantage, correct valuation, and huge growth opportunity. So exposure to growth factors,
Right.
right? This is what you need. And then you need around 20 to 40 companies
Right.
to create a portfolio, diversified portfolio, right? And from multiple sectors, maybe 4 sectors or more, ideally. So this is what we are suggesting. Of course, we talk about growth factors,
Right.
3 to 6 growth factors or
Growth.
more,
Right.
rather than sectors. But for the audience, if they're doing their own thing, they might not be able to figure out growth factors. They can just look at growing companies,
Right.
within this kind of thing. And obviously, you have to stay away from growth traps and value traps and quality traps, right? Which we have discussed some other time.
Absolutely.
Yeah.
Great. I think so that summarizes, I think, how one can go about still allocate capital, maintain enough diversification, go across large, mid, and small, to find opportunities, and keep a focus on the growth factor so that you are always exposed to, what is going to be the significant part of the market, in, let's say, next 10 years. So you are investing for the future. And that's the framework we wanted to share with you. So do reach out to us if you have any follow-up queries and questions. Thank you so much.
Thank you.
So always keep in mind that investment in securities market are subject to market risks. Read all the related documents carefully before investing. And also that registration granted by SEBI, membership of BASL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.